Live streaming is on.
All right. Happy Friday to everybody out there. This is event trader Gavin McGuire, and I am, of course, joined for the Sentiment and Flow show by none other than chart trader Brett Manning. So, Brett, how are you doing today, my friend?
I'm doing pretty good, Gav. How about you?
I can't complain. Can't complain. Just getting ready to go on a little bit of a holiday here.
Yeah, nice
But
time for it.
naturally, every time I want to step away from the desk, I feel like the markets start to get a little antsy and stuff. Not because I'm stepping away from the from the desk, of course, but just so happens to turn out that way. So some pretty interesting price action going on. And before we kind of pop into the sentiment and flow show, and of course, everything we're going to talk about from the past couple of days is going to work into this too. Wanted to get your thoughts. We had Pal out on Wednesday afternoon. You had provided a little bit of color there on the site, of course, but you haven't had a chance to kind of talk through your thoughts on audio. So I guess we'll start off with that, and we will go deeper into Pal. What was your overall thoughts on the Fed on Wednesday?
I thought it was very benign. I don't think it's the cause of the recent selling. I don't
All right.
think Fed funds futures didn't really shift at all. I just think it's a story. It's like people need a reason. And so often the reason is more kind of nuanced and it just doesn't play well. And there's a mimetic kind of process of everybody in the pundit sphere in the financial media all latching on to the same kind of explanation because it's just easy to say. And I mean, heck, I've even done it before and stuff I've posted, just like this is what we're all saying is the reason why this happened. So, every headline out there is, well, the Fed obviously disappointed the markets. And really, a lot of the time it's that the Fed is like a big benchmark catalyst in a multi-week kind of cycle. And the research shows that the vast majority, when you're not in a hiking cycle, the vast majority of Fed meeting days are very positive for the market, like 92% or something. And I just think there's negative seasonalities this time of year. This is about a 5 week stretch here is the most difficult 5 week stretch for the market. We know hedge funds are really short. And I just think it's possible that, there's a lot of people who were just kind of pent up selling in front of the Fed just, to see if that turned out to be a great day or if the Fed just ended up being crazy dovish. And that didn't happen. And so all those orders went through. I don't really think the story changed on Fed Day. And I know that's what has been printed.
Yeah, well, I mean, and we'll break into Fed Day deeper, but so taking a look at it, obviously we had some selling going on. Now we are, if you kind of pan out to a weekly, still in the range that we've been in since June. So that's definitely something that we are factoring in. I guess just and again, we'll be able to flesh this out a little bit more. Are you leaning bearish or bullish today, or are you just kind of content to sit back and allow for some patterns to develop before you'd want to fire on either side?
I've done really well lately in my personal trading. And what's helped me is not coming in with a bias. Really. Like just it's been the right time to not have a bias. And I just sit there and I just wait for something to show me something I recognize. And that's it. Completely open mind about direction. And I just and this is that's I think that's the way to handle a lateral consolidation like this. I mean, like you said, we've been pretty much sideways since June. It's a directionless market, and it's in a lot of ways it's narrowing. And just getting we're seeing so many big one-off days in both directions. Big rally, totally taken away the next day, then big decline, totally taken back the next day. We've seen that countless times over the last month. And the net result until this last couple days has been no firm sense of any direction establishing itself, and everything basically just you know turning that 50-day moving average just flat as a pancake. And yeah, that does suggest that what we've seen over the last couple of days is a little bit of a change in that. And I think we're coming toward a sort of do or die moment for bears, when we eventually, I would imagine, probably come down and test like 4,300 in cash. If we break that 4,330 area, we sort of trigger that neckline. You know, we're not sitting with a lot of complacency in the market right now. If we were, it'd be a really nice sort of head and shoulders top situation. And you just get that extending cascading decline that comes once you trigger that neckline. But right now, you know, I'm really up in the air about it. I think it's possible that we hit that trigger, we bust through it, and just, you know, there's just a lot of there's a sharp shift in sentiment that sets up a squeeze when we go back up through that same level, and we're just back in the range again.
All right. Well, let's not bury the lead here right off the bat, right? We'll get deeper into that as we
Well,
go through. So
right.
let's talk a little bit about some of the characteristics of this market and everything, Brett. Starting off with the AAII data, which of course was released yesterday. And you can see definitely a cooling of sentiment out there. The bulls had declined to 31.3%. Sentiment has been down for 3 straight weeks. The 31.3% was the lowest since May 21st, dipping below that August 23 low there. Bearish sentiment, of course, at 34.6%, also a 4-month high here, back up at the 4-week high, I should say, back up around those August 23 levels that we were seeing. So just kind of taking a look at some of the other slides on this, you can see that's the 4-week run that we've been getting. Again, once again back below the historical averages for bulls, and then we of course have the historical data for the 8-week moving averages, which we always like to look at just to kind of get a broader idea of the trend. We did see the 8-week moving average slip below 40 for the first time since July 13th, which of course would be the day before we got Q2 earnings kicked up underway. Not insignificant considering we're somewhat on the eve, just about 2 weeks away or so from getting, 3 weeks away, I guess, from getting the Q3 numbers out. And then the bull bear spread, we did see that dip back into negative territory for in the week of 9/21. Of course, this would have been the first time since the end of August where we were back in negative territory. So taking a look at that data there, Brett, what's your thoughts on the AAII? What is your read from what those numbers are telling us?
So we went from a long stretch, which we covered constantly, of way too bearish, you know, back in January, February, March, April. And then we had this June blossoming of bullishness that went, you know, it overshot, right? I mean, you can see the numbers on the first of the AAII slides. Like it was interesting to watch the balancing effect of overshooting one way, you know, after being in an too much of a skew the other way. Now, you know, if we're festering anywhere, it's festering in basically just middle, right? You look at the last 5 weeks, it's pretty much just sort of averaging out to about 33% in all 3 categories. It's just like the market looks, right? We're in the middle of a trading range until yesterday. And this has been in the middle of the range of sentiment. There's no directional signal here either.
What do you think is the biggest drag on sentiment? I mean, certainly when you're looking, we're at 51% bullishness on July 20th. We're getting up near some of the year-to-date highs at that juncture. Mm-hmm. Since then, as you said, choppy direction, not really getting hit by any matter, but you could argue a descending triangle pattern. You're talking about the head and shoulders and the importance of this neckline providing support coming up here. None of the data, though, has necessarily gotten negative. Certainly a push higher in rates over that time frame. That's been an impact. What do you think the number one drag is on that sentiment, Brett?
So I think there's a feedback loop between sentiment and price action to some extent. To some extent.
Right.
To some extent, that's not the case, but especially when you start to go from transitioning from one extreme to the other, there's no reason for everybody to have turned bullish in June, except that the market proved all the bears wrong. Like, that's it. That's what happened. You can see it right on the chart. Like, the breakout happened, and then the bullishness happened. The bullishness didn't cause the breakout. It responded to the fact that the market was suddenly just charging higher. And then, of course, you get this sort of rosy glasses effect where when the market is ripping higher, the financial media is focusing on the amazing AI story and the boom in productivity. And here comes 1995. And this is all just going to be crazy awesome. And that's a response to what they're seeing in the market. And so there's a feedback loop until it gets, past any sustainable point in terms of positioning, and especially short-term positioning. And then, you're going to get that correction, and we're in that consolidated period now. But I think if there's a drag that's external to that, honestly, I really think it's the political environment. I think I don't think there's anything that is more zeitgeist impactful in this country right now. And anybody who's involved in markets, you're feeling that every day. There's just a completely dysfunctional political situation here.
How much do you think? Because we're looking at the August 3rd read, we're at 49%, right? August 1, I believe, was when Moody's downgraded the U.S. debt,
and that's why
we started seeing the increase.
Yeah.
Rates definitely started picking up at that juncture. So that plays right into your zeitgeist.
Does anybody believe that we can handle a tough challenge and come together right now? Like, no. So that's a massive vulnerability. It's not just a feeling. I mean, it's a real concrete vulnerability.
Well, and you got to figure too, the government shutdown coming up. Now, everybody knows the 11th hour shenanigans that goes on around these. The chances are come September 29th, we're going to have some continuing resolution out there, something along those. Well, I mean, each
one
time
side
we get closer,
wants to sow chaos into the system right now.
Yes, but
and that means that it's tougher to get the compromise.
It's tougher to get the compromise on that front too. And when you get one side that's willing to drive off the cliff, and you get the other side that's willing to let them drive it off the cliff, it's just kind of impossible.
It's a bad mix this time around.
It's a real bad mix because like just watching, you see that Problem Solvers Caucus, and why they can't just take control of things is beyond me. But it points to that thing of the discontent. Number one, you got the one side that's so miserable that they want to drive us off the cliff. Number two, you got the other side that thinks them driving off the cliff is going to win the election for them.
Right. I mean, both sides probably think that in the end they can spin it.
Exactly.
Everything is now, we got the echo chamber so firmly established that there's such confidence in the ability to get your missionaries out with the word and spin it in your direction with your base.
And for me, it's kind of one of the reasons why I remain a little cautious. I'm not negative because we'll get into some of the position and sentiment, but it seems like a lot easier sell for bears than bulls over the next week, given the price action we've seen, what we see on the charts. A lot of names moving below their 20 and 50-day moving averages there. We just had the S&P with the highest percentage of 52-week lows since March, which I'm sure you're going to point out, Brett, is more of a counterpoint in favor of the bulls. But it just seems like it's going to be real tough to get buyers off the sidelines, how I see it over the next
especially
week.
And you got the seasonality. I mean, that it plays into things, especially on the professional money management side. I mean, it's really easy history to see. You want to buy at the beginning of the last week of October and hold to year end. And between now and then, anything goes.
Right. Obviously. And that's what I'm really curious to see what happens with Q3 earnings. I see that as the next big catalyst. So let's move along here with our discussion and get into some of these market characteristics that we're highlighting here, Brett. Just a few of the things that I've got bullet pointed, and then we can circle back. We're going to talk about each one a little bit deeper here. Choppy conditions, obviously, range bound since June between, this is going off the continuous S&P, 43.50 and that 46.30 area. So, a relatively wide band, but, over a 3-4 month period, that's definitely a tight, choppy conditions. Fed commentary drives equities. towards the lower end of the band. Again, Brett, I know you take a little bit of umbrage with that, but when we're looking at it, the 10-year did pop to 4.47. So there's some
Sure did.
positioning that the Fed commentary, I would argue, at least provides some wind behind the sails of those bond
Didn't move the
shorts.
Fed funds futures.
It did not move the Fed funds futures one bit. And I think that the Fed funds futures did a pretty good job at pricing this in. If you look at the CME actions over the last 4 weeks.
So that's a
going
more
into
efficient
this.
market than everything else, than the
Yeah.
bond market.
I wouldn't say it's the more efficient market, but in terms
less
of reading,
liquid.
reading sentiment for equities is what I would argue.
Okay. Well, you mean okay.
Is that a fair comment?
I think that it's a less efficient market, and it didn't move, and the bond market did move, and equities did move, and I would just say again, I think there's a lot of people
You're
that
saying
were
the Fed
just
funds
waiting.
futures is less efficient.
It's less liquid, so
Less
most
liquid, right.
likely it's less efficient. But it's efficient enough. I'm not saying it's wrong. I'm saying
Right.
it's right, but it wouldn't be more likely to better discount something than the stock and bond markets. And I just think it's more likely that people had earmarked sales in stocks and bonds for post-Fed, regardless of unless Powell came out with just we're definitely done. You know what? We're going to cut rates next month. Otherwise those sales were going to happen. It wasn't, triggered by Powell. I think that there was pent up selling in stocks and bond markets into that meeting. That's my theory.
Yeah.
We'll never know the answer. It's pointless to
Right.
debate.
Yeah. No. I mean, and it's a fair theory, and you tend to have pretty good theories. So I certainly don't want to dismiss that by any stretch. We'll get into the
History will support the other story.
Exactly. It all depends on who can spin it better, right?
Yeah, exactly.
So Fed did not address market concerns in its meeting. We'll get into that in a little bit. And then just some tense days for the markets here as we are at the lower end of that band. You were talking about that head and shoulders neckline that needs to come in and provide a little bit of support. So these are the big things facing us going in at the moment. And of course, seasonality, as you had pointed out too, equities or earnings on the horizon. So let's talk a little bit more about that Fed meeting, Brett, since it is being pointed to as a prime catalyst by a number of people for the drive lower. We cover the Fed pretty thoroughly every time it comes around, and we discussed how there was very little new that was introduced to it. That higher for longer theme. I'll just go through these bullets real quick, Brett. The higher for longer theme was obviously what the mission statement was for the Fed going into this. They did this through numerous levers, as I suggested in the preview, raising the terminal rate for 2024 and 2025, raising GDP and inflation expectations. 12 of 19 expected one more rate hike according to the dot plot. And all this led to yields popping and equities dropping here. Now, for me, Brett, there was two really big aspects to it. And that would have been Powell's comments around neutral rates being higher for longer, although that statement was really just kind of talking about what was pretty evident in the terminal rates laid out in the summary of economic projections. And one of the things that I was seeing in the 2 days in front of that conference was hopes that Powell would give a nod to the UAW strikes, the government shutdown, the screenwriters and actors guilds. Very barely touched upon them, though, Brett. He didn't highlight.
He said there's a lot of things that increase our uncertainty right now, and then he ran off that list.
Yeah, but he didn't really address it as we see risk balanced. When you look at the amount of time, I mean, he led off his thing attacking inflation remaining too high, and that was the focus of, I would say, if you were looking again, Brett,
sure.
to my point, it was about people thought that at the end that they might hit a little bit more of a balanced tone, and I would say it was 70-30 at best in terms of
you mean
the
downside risk to the economy in terms of growth.
Correct.
When you say, I mean, all he said was, look, it's been this economy looks like it's much stronger than we thought it would be. That's why the possible neutral rate is higher. That's why the higher for longer. It's not because of stagflation. It's because of a more resilient growth economy.
Right, and that is a key distinction too, right? I mean,
Huge.
and I talked about it. I mean, it would have been a lot worse for the markets if we got we're kind of stuck here. We need to tamper out inflation. We know we're hurting the economy, but this is a necessary medicine, right? He didn't really go down that at all. He just kind of continued to hammer home how strong the economy was.
Not that bad. That's not a bad thing, right? I mean,
no, it's not exactly.
Yeah,
there's reasons for rate hikes and
right.
and there's reason for inaction, and I don't think that any of the things. And again, the dot plots, we're kind of at that level that they want to get at, right? Maybe
The dots
maybe
are
two
policy
more.
now.
Yeah,
The dots are policy now. It's not that they're going to hike. It's that they know that if they keep people expecting another rate hike, it's going to keep a lid on inflation expectations between now and then. I think that they're clearly using that as a communication channel piece of policy at this point. I wouldn't trust the dots at all to actually be the independent opinion of the people on the Fed. I think that this is a managed system. It's a great new tool because people haven't gotten to, every time they introduce a new tool, eventually it gets discredited because people realize it's a managed form of manipulation. And
exactly.
Then it becomes less valuable. And right now the dots are really valuable. And all they got to do is all say that, that you got to have a majority of people that we're going to have another hike. And that right there will keep inflation expectations in line in the meantime. They don't ever need to do that hike. That will do it.
And it removes,
and they know it.
It removes the potential for a Fed chair, and I'm not talking Powell, I'm talking any of them. It removes the potential for them to put their foot in their mouth, right? Because they have less explanation to make around it. They just stick to their script, and they look at the dot plots.
Look at the dot. Exhibit A is all you need to know.
Yeah, and just kind of let that uncertainty around, like, let everybody's head go a million miles a minute without them having to say anything.
Yeah, I think it's completely managed messaging device.
Yeah,
that it's brilliant right now. It's going to be great. It's going to work really well for them until people start to until there's a consensus belief in what I just said. When it's sort of like, oh, we know that's just they use that to just control expectations.
Yeah,
and it goes the way of like so many other tools that they've come up with over the last 40 years, where eventually it just doesn't matter as much.
All right. We're going to continue this discussion here. Just keeping an eye out on markets, Brett. Right around 43.86 in that December contract for the S&P. So, all right. So let's take a look at some of the recent fund manager survey data that would have come out before the Fed, of course. So, be curious to see how this changes going into next month. Is the Fed done hiking? Conviction the Fed is done hiking. 60% said yes.
That's that labor data. That's that JOLTS data, that consumer confidence. I mean, like, that was the main issue for the Fed. Along the way, it was the tightness in the labor market. That was the thing that made them feel, like we can't get control of this. It's that factor more than anything, because that trickles through everything. And when you have two jobs open for every applicant, you're going to have a problem.
Now, 60% said that. Quick look at the Fed, and we basically had just about 60% of the Fed say that they're not done hiking, right?
Yeah, but again, we've covered it.
Do you think? But again, do you think that just kind of has to do with some of the fast, loose money getting shaken out here?
I don't think that's why the market's going down.
Okay.
I think that there's a lot of reasons, and I think the political dysfunction is part of it, and bad seasonality is part of it, and just we're working off some hot money out of the market, and I don't think that it's a reaction to the Fed. I think that and also there's just a natural look. We're normalizing the yield curve, as far as I can tell.
Yeah, no, and that's one aspect that's not getting played up enough.
That's not like, if you've got this is not, we're not heading into recession, and the yield curve is responding to that. And that's an issue for stocks because the rate of change in rates at the long end is the price of money is the ability to plan for every business, consumer, and everybody financially. Like that's moving. It's a moving thing. It's moving fast. It's moving higher, and that's a factor. Price of oil, that has nothing to do with Fed policy. That has to do with Saudi Arabia and Russia looking to sow chaos, I would say. And
yeah, it doesn't, but at some point though, Brett, it does, right? I mean, because if gasoline prices at the pump are driving higher, we got the student loans starting back up right next month. It's going to crimp the consumer. It's going to crimp demand. Definitely saw some aspects of it. So,
right,
they
it's
don't.
bad.
Yeah, but what I'm
The
saying, Brett,
stock's down.
exactly. But Brett, it does factor into a certain extent. I know that they don't control it, but they do
Well, that's
control
the
some of the
thing.
other
Yeah.
levers of it.
Can they ever? Yeah. Right. So, and I've written about this like 1,000 times lately in my morning notes. Like, this is really interesting. If oil goes above 95 and stays there for 2 weeks, is the Fed going to start to go, this is a problem, and it's a problem that we don't have a direct tool for dealing with, but we got to do something.
But you also have to think too. It does factor in some of the demand in other areas.
It's also a
Shelter, for
tax.
instance. Yeah, it's a
Yeah.
tax, exactly.
Yeah.
But it
But it's
helps
a
them
headline
with
inflation expectation builder.
it helps them with the tightening process without them needing to use the
But it
interest rate
also
as a lever.
increases inflation expectations. People
True.
feel that, and we're 3 years in above target. Like
Right.
I got the last time it was probably the 70s that we got 3 years in above
Yeah.
target. And at a certain point, the duration element becomes the main element in whether or
Right.
not you start to get inflation expectations just becoming unhinged. And I would imagine this is a pretty sensitive window. And if people start to see $5 at the pump after 3 years of above target inflation, we're probably, I would imagine, there's got to be at least some theory bouncing around at the Fed that's a significant concern. And
Yeah.
what can they do? There's one thing they can do. They can counteract the higher energy prices by tanking demand in other areas, putting us in recession. And that will take care of those inflation expectations. And they're concerned about the structural time frame, not the cyclical time frame. So that's the most bearish view you can get right now.
Right.
That is, to me, that's why I focus on it. That is it's not likely, but it's got maybe a 15% chance or something. And it's the crash scenario. It's the real big boogeyman.
Exactly. It's not likely, but it's an easy story to push once.
Oh, and it's right. It's memorable and communicatable and
makes great headlines.
makes good headlines.
You
Stagflationary
talk about the
recession.
reinforcement there in the news. So
right. So it's unlikely, but it's not. If oil keeps going higher and it stays there, and we start to get real measurable statistics on inflation expectations starting to move outside of the zone that the Fed is comfortable with, then at a certain point they have no choice.
Yeah. So looking around, obviously the Fed was trying to push the higher for longer. So we got a slide here on the first Fed rate cut from Bank of America's fund manager survey. The second half of 2024 is where the majority of people are at 38%. Q2 of 2024 was at 36%. Again, this was taken before the Fed survey. Do you expect to see a big change in this? And we talked about not a big change in the CME Fed funds futures as they had already started kind of pricing in some of this.
Yeah, no, I mean, this is where we are now. It could easily change, especially if the aspect of oil prices being higher and a tax starts to move us more in the direction of some weakening trends. I mean, that could move back up again.
All right, and we talk about inflation expectations here in the next slide. They did start to peak up a little bit as CPI came in a little bit higher, or a little bit stronger last month. So, do you see this trend continuing? And then, of course, looking at that drop off in short-term rates, that talks a little bit about that steepening of the curve that you were talking about.
Yeah, no, right. I mean, I think it's more just normalization for the curve, right? I mean, like at a certain point, it's unsustainable to have this level of inversion when you've normalized some other aspects of the post-pandemic economy. So, I mean, I think that, and I think where are we at now on the 10-year? We're at
447.
447. And like I noted yesterday, really interesting thing to see yesterday, to see the 13-week T-bill down in yields when the 10-year was blasting off in yields, and see junk bonds basically flat. Right, that's a tightening of credit spreads with the curve, steepening significantly in a single day. So significant steepening and a tightening of credit spreads to junk, which is, I mean, that is, that's just what we saw in the previous slide. When you look at, we won't need a Fed cut, for a while. Like, I mean, that's all, honestly, that's a very bullish statement by the markets in terms of the economy, in terms of the resilience of the U.S. economy and the strength, to see credit spreads tightening and the curve steepening. Any day you see that, especially when there's a significant move in yields, like, that's a really direct statement that the market is making.
Yeah. Real quick, spike to session highs here in the S&P up to that 4393 area. Getting close to a test of 4,400. There is a Wall Street Journal story out with regards to the UAW strikes, where the UAW is planning on extending them at General Motors and Stellantis. But Jim will be happy to hear this. Apparently, Ford could get spared as there's making some progress in contract talks. Now, I don't know if that's having a positive impact on the markets. There had been some concern around these headlines hitting midday, so we'll keep an eye out on that. But definitely got that spike to session highs here right around the time of that release. So watching that closely. All right, Brett. Moving on. This is something that's got to have the Fed pretty excited. The services ex food and energy lowest since November of 2021, and pretty good looking chart
Super
there, right?
core. Yeah.
Talking about your necklines coming into play here.
Yeah, that's really that's great.
So that's what the Fed's got to be happy about. If we could get something settled with energy, who knows? But you got any thoughts on this chart?
Well, yeah, I mean, that's sort of it's a great chart. The JOLTS chart. It's a great chart. Put this in JOLTS together.
Yeah.
You got some great stuff, right? I mean, everything is just coming exactly perfectly into that perfect utopia zone. When you've got this strong growth and all these things that were skewing everything toward a price control problem are just kind of just melting away, like, reversing the spikes, and they're far enough into those reversals that you trust it. Like, there's a trend the other direction now that's taking everything back into the sort of long-term normal range. Everything's just kind of, it's like the pulse of somebody going through some kind of like serious health issue, just suddenly coming right back down to the normal pulse rate, and the patient is stabilizing, and except in stuff we can't control. I mean, if Saudi Arabia and Russia want us to have a big problem right now, and this is the way to do it, I mean, there's definitely an element there, and there's no reason to be continuing to cut production at this point, other than geopolitical.
Yeah, agreed. And of course, we are just about 12 months away from the election, right?
Yeah.
So.
Right.
Fed balance sheet, they continue to reduce this. I saw Bank of England yesterday morning, Brett, also come out talking about accelerating their reduction of the balance sheet. But again, this goes back towards your normalization discussion here, where you want to see the fixed income markets acting a little bit without this big invisible hand coming in to disrupt things here. So this is good news. It's trending in the right direction. We were heading lower, then had that one pop back up, which of course would have been right around the Silicon Valley issues there, but going in the right direction on the Fed balance sheet.
Yeah.
Okay, let's take a look now at the Bank of America fund managers survey, some of the more interesting aspects of this, and then we'll kind of dive into them a little bit deeper just looking at the 30,000 foot view. No longer bearish extremes going on there at the time. Now, this, of course, again came out before we had this little bit of a rollover. So, towards Brett's reinforcement theme, that's something that should be of interest next time we get the survey. 17-month high in global equity allocation. So seeing a little bit more money flowing out there. 74% say soft or no landing. So that seems to me like a read through that the Fed's managing this to a degree that investors are accepting. 75% say short rates will fall, again towards Brett steepening into the yield curve. Japan remains a big winner here, biggest overweight since 2018. Inflation expectations, as you were saying, Brett, over the long run, the highest since May of 2022. And then the biggest jump in U.S. exposure ever in that. So, just kind of taking a look at some of those bullet points. Anything jumping off the page to you?
I guess biggest jump in U.S. exposure ever. I didn't.
Yeah.
I had missed that.
Yeah.
I mean, that's a very catchy statement. Is it, if we drill down, do you think that really holds up?
Probably
or is it just
not.
a sensationalized way of saying something more mundane?
I would say just kind of cleanest shirt in the laundry, right? I mean,
Yeah.
And again, this points to a few other data, but we did see some money flowing back into China, but and we're going to get into the China pessimism here in a little bit on this, and of course Europe. I mean,
Germany,
that's just
yeah.
that Germany's just been a dumpster fire of economic data,
Yep.
right?
Yep.
And those high energy prices, obviously, a massive amount of inputs that they have to deal with there,
And
factoring in
reconfiguring
as
their
well.
entire energy infrastructure.
Yeah.
For a 5-year plan of, hey, growth is going to be really slow. Like they came right out and said it. The next 5 years are going to suck. Like that was official German government statement.
Yeah, I mean, looking at their market sentiment this morning too, those PMI releases weren't very encouraging.
Yeah, it's going to be bad.
Yeah. Is that German or is that Norwegian?
Ich spreche ein bisschen Deutsch, aber nicht so gut.
There you go. That's a little better. So the next slide, and we'll continue on with the BofA Fund Manager Survey highlights. But Brett, this is one of your favorite charts to watch, and it's from Jason Guppert over at Sentiment Trader.
Sometimes it's one of my favorites, but it moves a lot.
Sometimes. Well, and you can see from that big dip that it has moved a lot.
It's pretty dramatic.
So why don't you walk us through this? Because I think this is a key aspect of what we're looking at in terms of price action and that big whale just sitting on things that's making it tough for us to go up.
Yeah. So I mean, this is so it's a measure that's constructed by looking at the relationship between HRFX benchmarks and the SPX on a day-to-day basis, and you can see you can derive the overall exposure based on that relationship. Where the hedge fund benchmarks go is driven by their exposure and how their positions, given their exposure, perform. And when you just look at the benchmark then versus the S&P, then you know how they're positioned relative to the S&P. So we can through that means we can get sort of a 30,000 foot view on how hedge funds in general, because the prime brokers contribute to the ability to measure the HFRX. And so we know, like, there's data under the surface that result in that blue line. And that blue line is, the sort of the derived exposure index. So when it's way down at the bottom, that means they're really short. When it's way up at the top, that means they're really long. So it's above the red line, they're long. It's below the green line, they're short, as a cumulative aggregate index. So the important thing to me is when we see a sudden change. And so if you look at the recent action, you see the big pop upward above the red line, followed by the crash downward below the green line. The pop upward was June. It was the market squeeze. They were all just shorting like crazy in that range in March and April and May. And that was capitulation out. It was normalization. So it's a lot of people covering shorts. So you end up with a big net long when you have everybody who's short covering. that's where you end up. But they really wanted to be short. And the second we lose momentum, they just start hammering back in again. And there is just a philosophy there that we're seeing where there's a big bet that some big hedge funds want to be taking right now, where they really, really, really have a lot of conviction in a bearish outcome to what we're seeing. So that's the blue line.
Yeah. What do you think could scare them out of that?
Higher prices.
Yeah, just
Risk.
momentum itself, where
That's what does it to these guys every time.
They're getting pressured into covering.
It's every time. It's the same
Right.
thing. They get out over their skis, and they don't see the fact that they're all in the same position. And then it starts to go bad.
In June,
we saw it lots of times historically.
Yeah.
Like there's just there, and a lot of these are young guys in a lot of cases. This is money. You think these are not the smartest people in the room. I know a bunch of them. These are not the smartest people in the room. In a lot of cases, it's a 25-year-old kid who just got out of Wharton, whose family has really good connections to money, raises a $800 million hedge fund, and says, I'm just going to go and do this. And he's just ready to eat red meat every day and just crush it. And it's just decisions on that level. There's a lot of money managed that way. A lot. And, they're aggressive. It's not their money. It's somebody else's money. And they're young and hungry. That's got to be 70% of this money. That's my bet. 70% of this money, it can be summarized that way. So this is not necessarily a sign that the smartest people in the room are doing something. Now, it could be. There's obviously some really, really brilliant money managers out there with hedge funds. But there's a lot else that's added into that paradigm. And over time, historically, there's no question, you beat the average hedge fund and the accumulated returns from hedge funds over any given decade, over the last 3 decades, by holding the SPY. So take that for what you want.
All right, so we'll be watching this continue to evolve to see if there's any sort of short covering coming down the road. Institutional buying. This is another from the Bank of America chart or fund managers survey. You kind of looking at the AAII total stock allocation on the way up. You're seeing a big pop going on the net percentage of fund managers overweight global equities, but that still remains in negative territory, suggesting that there's still plenty of institutional money on the sidelines. Do you think a shakeout like we're seeing here could open up that opportunity?
It's going to be awfully interesting to see. I think that's one of the. So I tend not to try to predict that, but watch it and know that that's a possibility. And if we break 43.30 and we get, a reaction, a pukey reaction, and kind of a sense that, perhaps we could see it in the options data. Put call goes to 160 or 180 or something, and we get a sense that it's just like everybody's just really to flip to a really dark view, and then the market holds, and you know what that is. That's exactly what you're saying. There's just a bucket in there, a basket.
You know what I've been finding, Brett, that works as a pretty good parallel for that spike in the VIX. And not a surprise, but the TA page scans. When you start seeing those VIX ETFs populating the power up or power down, it's been a really good indicator of short-term tops and bottoms.
Yeah.
So
maybe if you match that with put call and with ETF inverse ETF average volume.
Yeah.
The volume, like if you see a lot more volume trading inverse ETFs, you see a pop and put call, and you see exactly what you're talking about with those different types of VIX ETFs, then you might have like a sort of day-to-day kind of, because you need something shorter term for these technical breaks. Like you want to know, is this exhaustive or is it the beginning of a cascade? And if you get a technical break and everybody just stays complacent, you got a problem if you're a bull. But if you see it, like the neckline of a Head and Shoulders bust and put call goes to 180 and, VIX balloons to the roof and there's just massive participation in inverse ETFs, you can be pretty sure that that's as far as it can go. Like it's trying with everything it's got to get there. and everything is being thrown at it. And if there's any kind of stabilization in price, a big front has a big back.
Yeah, keeping an eye out on these markets too. We are seeing that rally run out of a little bit of steam, so good test here for the bulls to be able to try to maintain their early morning gains here from this bounce. All right, moving along, cash allocation. No big changes that it's kind of been running around this area here. Remains below 5% at the moment. So we're just watching that. You can see it's pulled back a little bit, but certainly not at any level that would suggest that a lot of money has pulled off the sidelines here. It's just slowly kind of trickling in, it feels like. Here's the U.S. allocation jump, Brett. And this is the chart that I was talking about. Now, this is, again, they talk about the biggest jump ever in U.S. allocation versus emerging market stock allocation.
So that's probably just coming
This
right out
is
of China.
the net percentage, exactly. The net percentage of fund manager surveys overweight U.S. equities minus the net percentage of fund managers overweight global EM equities. A lot of that is China. So,
Yeah.
and what we're going to talk a little bit deeper about China coming in here. So, any thoughts on that?
Yeah, no, I mean, I think that sums it up.
Right, that pretty much sums it up.
You want to find a bear sentiment extreme. You just look at China, like it's ringing all the bells. But then again, is it really a free market? So do you, it's just, you can't. I got faith in the U.S. when we get a sentiment extreme. I know it pays off to take the other side of that, but China, who knows what they've done to keep their markets up under the surface. Like the sentiment might be there, but the market hasn't priced in most of it because it's just some sort of source of price, something unnatural interfering with the market's ability to price in what's happening. Yeah, so I don't know.
Looking at tail risks here, Brett, we always kind of give it the caveat that there's the question isn't necessarily always the cleanest, but high inflation keeps central banks hawkish. That's certainly been on display, but that is down from prior worries. Geopolitics worse, and that came in second at 14%. Now,
it's Ron DeSantis.
What's that?
It's Ron DeSantis.
What is?
In the primary polling, right? I'm just saying.
Yeah.
The distribution here is not
right.
There's one candidate, and that is high inflation.
Yeah, and exactly. But you could also argue, if you're looking at energy prices being the primary goal, and Russia and Saudi Arabia are pulling levers on that perhaps it should be given a little bit of a higher allocation. Systemic credit event, either government or corporate, that's always going to be a risk, I suppose. Bank credit, that's running around 13%. AI tech bubbles, only 10% there. So I don't think anybody thinks that
the correction did its job.
Exactly. And then the China real estate bust, 8%. So surprising that that's lower than it is there, but I don't think that there's really too much on the surprise on that tail risk front. But you talk about the bearish extremes, and there's a few slides that we had in this. Look at this China assumption. Look how low that is. I mean, we are seeing a little bit of a push higher in some of these Chinese ADRs today, Brett. Some more levers that the PBOC and the government are looking to pull. This one, the latest one, was to relax some of the rules around foreign ownership of equities and stuff. What would it take for you to look to put some money to work back either in the EEM or specifically into some of these Chinese ADRs like a Baidu or a Baba? What would you need to see in order to get yourself kind of excited on that front?
So here's the problem. Everything that I would need to see, I already see. And everything that stops me is something I know I'll never be able to see. You know what I mean?
Yeah.
Like every sign is there. This is like if it was truly a trustworthy situation that Chinese assets are absolutely, behave according to free markets, and that there's not manipulation in there that's actually directly interfering with the market's ability to price and discount. If I knew that for sure, then this is obviously the sentiment is, just imagine asking anybody who is, like an experienced investor with a lot of, with like a family fund or some access to serious wealth, like, would you put your money in China right now? You're going to get no every time you ask that question to anybody. There's no doubt about that. And that's exactly when, presuming they're actually functioning markets, that it doesn't matter what comes next in terms of news, like all the risk capital's gone. But again, it may be the case that there's a lot of domestic risk capital that's been forced to stay involved that doesn't want to be, and that will eventually rebel in some manner that I can't even predict. So everything that I would want to see is there, and anything that would be stopping me, I have no way to deal with philosophically, because I know that I will never see it. It's just tough.
Yeah, and just looking at this China real estate risk, you could see the pop up there. USEU commercial real estate risk has receded a little bit here. Still got shadow banking in US, but that's receded. But again, this kind of just points to the uncertainty around China and just how it's weighing in on things. Last slide that we're going to show, just kind of showing the Fed bank lending that remains elevated. But Brett, you got another theory on this. You don't think that this is so much troublesome as much as a couple of guys have found a way to how to make some easy money off this. Would you agree with that?
Yeah, I think basically.
Yeah. So we're keeping an eye out on this. Certainly going to be watching a lot of the commentary for the banks coming up. Seeing a lot of people just throwing these out, saying that they're uninvestable with the expected regulation. So that's going to remain a headline. But, this facility, while it remains elevated, we would be cautious, just kind of reading too much into that. So that's going to end this sentiment and flow show, Brett. There's certainly a lot of interesting aspects coming, but when we're kind of looking at the data, there's still a lot to remain bullish on in terms of where pessimism is, which is not quite at bearish extremes, but
No.
certainly weak positioning. It has improved, but still you could see plenty of room for buy the dip players to come in here and drive things higher. So overall for the rest of the year, I still think that we remain in a pretty decent spot, and I could see some patches where we could push higher. But in the short term, Brett, just with some of the strikes going on, the government shutdown, historical weakness going on, I still remain a little bit cautious here. So not ready to put the bazooka to work just yet, but boy, am I just kind of searching for any sort of weaknesses or pullbacks to jump into. And that's kind of how I'm looking at the market. But I want to hear what your synopsis is of our discussion today.
Okay. So we came into the year with extremes in bear sentiment. It was a primary driver for Gavin and I to be, I think, overtly very bullish about how things would resolve, at least into mid-year. And we got that move. We squeezed the bears out bad. We converted most analysts on the street from, having a 3,000 price target to 4,700 or something. And that it was a flip. The flip primarily is evident in June, and you can see it on the AAII data, but it was happening kind of throughout. And the government shutdown take one version debate in May, I think, was part of keeping a lid on that and making the breakout extra directional. And the banking crisis situation that emerged kind of did the same thing of keeping people baked into these really bearish views, eventually kind of getting squeezed all at once in one dramatic move. And that process turned everything around sentiment wise, and we kind of overshot the other direction into July. And this is not like this is. It's almost like I'm describing the psychology of every Elliott wave bull pattern ever. Like you get the first wave when everybody stays bearish, and that second wave correction, everybody's really bearish because they're looking for the new lows. It doesn't happen. Wave 3 comes booming out of that. Everybody flips, but they flip too far, and then you get this sideways trickling consolidation that gradually works off that excess bearishness, and then you break the lows of that, and you see a big accumulation bid sitting under the market, and just at the same time, people have found a bunch of new stories to become bearish about, and that's where wave 5 starts and you take off again to the upside. And it's just like it's like textbook, and it feels a little bit like that's kind of what's playing out here. And the head and shoulders sort of pattern here offers a good opportunity to bust that neckline, get that bearishness to kick back up toward extreme territory, and then to kind of find that somewhere in that 4,200 to 4,300 area there's a big bid, and that it's in a serious accumulation, and it's going to stay above the range that we broke out of in April and May, and that's the level where we kind of re-trigger the next wave higher, and that's probably going to match up with seasonality coming into the end of October and through the end of the year, and that's probably going to be a really nice period for the market.
All right. Well, Brett, I think that's going to conclude it for us. Just as a reminder to everybody, I am going to be off the desk next week, so I'll be returning on Tuesday at October 3rd. But Brett will certainly be around, and as will the rest of the team, so you'll have plenty of guidance.
But we won't know
there.
what to do or think because Gavin actually tells us everything.
This is true. So I'll send
every morning we have a
messages
meeting. Gavin tells us what to do, what to say.
Well,
So,
I'll be sending those thoughts from Italy, so you're just gonna have to
Okay.
talk with a lot more hand motions and
Okay.
stuff, Brett, moving forward. But hey, Brett, always great to get your thoughts on this. I'm pretty excited for some of the trading potentials that are going to be out there going into the final quarter of the year, certainly around Q3 earnings season. And I think it could be a fun time with some pretty nice opportunities to make some money going into Q4. So we'll definitely be following your commentary closely on that and your trades as well. And you, my friend, you have a great week next week, and look forward to chatting with you soon enough when I get back.
And enjoy the wine and food and football.
That's the plan. I just wrapped up my AS Roma ticket, so I'm excited to go check out a European football match. I've always wanted to do that. But and everybody else, we're going to be shutting down audio just temporarily here. But soon enough, you'll be once again regaled with the smooth and sultry sounds of Jim Z as he's going to once again take
nice.
take command of the con here and lead us through the rest of the day. So everybody out there, have a great day. Look forward to chatting with y'all when I get back, and we'll talk to you soon. So, Brett, you take care, and everybody talk in a little bit.
All right, take care.
Bye-bye.